Good evening, everybody, and welcome to the October 2024 Investing Roundtable. This is Ken Kabula. I'm a director with the Mid-Michigan chapter, and my good buddy Mark Robertson, who's the Chief Investment Officer for Manifest Investing, will be joining us tonight, and he's co-sponsoring this particular roundtable as he has for the entire 14 plus years of our existence. We also have our good friend Cy Lynch from Atlanta with us tonight. So we're going to hold down the fort, the three of us. If Hugh should manage to stop in this evening, he'd be very welcome, but we're just not certain whether he's going to be able to make it or not. Okay, with all that said and done, why don't we get to the particulars? I see that we're riding rhinos this evening, Mark, is that right?
That's correct, and I want to give a shout out to Sean Mace from Eastern Pennsylvania, and Sean does some things with us, and Sean loves playing with the images that can be generated, obviously, with AI systems. And the rabbit, as most of you in the audience know, is celebrating our Red October effort to identify our best small companies, and more on that will be coming here in a few minutes. But thank you, Sean. And that rhino's practically jumping off the page. I kind of like that.
Well, it's a nice looking animal, and it has the right number of horns. I've noticed that a lot of times AI generated images seem to grow extra fingers and toes and legs and horns and everything, but this rhino looks pretty realistic to me.
We can't tell if he has opposable thumbs though, so.
All right. No investment recommendation is intended this evening. We will be talking about real stocks in real time, but they're only for illustrative purposes, and we're not asking you to buy, sell, or hold anything. In fact, we really believe that the members of our audience are smart enough to do their own investing, to make their own decisions, and to manage their own portfolios. We might hold some of the securities in our own portfolios or in those of our clubs or clients. And if we do, we'll try to disclose that when we talk about them, but don't hold us to that because we many times have our fingers in a number of pots here. If you need copies of the slides, you can get them from emailing Mark at his email address, markr@manifestinvesting.com. And if you have Q&A that become unanswered during the session or you don't get around to, drop us a line at either one of the email addresses and we'd be super happy to get you involved. If you'd like to subscribe to the roundtable and get a monthly reminder with a link for registration, then go to betterinvesting.org/chapters/Mid-Michigan. Scroll down the front page and you'll see a very easy to fill in box. It only asks you for three things. Fill in those three items and press send, and your address will be added to our guest list. And then my wife, who graciously keeps track of that guest list, will send you one email a month notifying you of the date and providing a link for registration. We promise it'll only be one email a month from us just to talk about the roundtable. So with all that in mind, we're getting ready to start. Here's our performance, and I've mentioned already that this goes back more than 14 years. We've been doing this program for a long time. I think that all three of us are a little bit surprised that we're still doing it. When we started this, we meant just to have a little bit of fun and do something for a year or two, and here we are doing it 14 years later. Our goal has always been to beat the market wherever the market happens to go, and it's really been going this past year, but we've been trying to beat the market by at least 5 points. If you'll notice, that orange line on the graph represents that +5, and this is a graph of relative return. That means it's a graph of how many points have we beaten or lost to the market in the last month since we talked with you at the last time. So we're down to our own performance right now at 17%. That's since inception, since we began the program, we're doing 17% compounded annually. And I think most of us in the room would accept that as a really great performance over almost 15 years of investing. The Wilshire 5000 has also done pretty well over that time. It's done 12.6%, and we use the Wilshire 5000 as our benchmark. That's the benchmark, that's the index that we're trying to beat. Well, if you subtract those two numbers, you get 4.4%, and that's our outperformance, our relative return, and that's what we've graphed in the most recent dot on the graph. We also have been aiming at a 55% accuracy. What that means is we'd like 55 or more percent of our choices to beat the market. And our outperform accuracy, we've been working real hard to try to push it up. It moves very slowly, however, and it's at 46% right now. So we're a little bit under our goal of beating by 5 points, but we're still within hailing distance. Our outperformance accuracy, we'd love it to be at least 50, and 55 has been our goal for a long while. I think that explains this slide pretty well, unless you have something else to add, Mark.
Yeah, the only thing I would add is when we go back and look at the all-time achievements, Ann Manning has an outperformance accuracy of about 65%. So I think she should help us all figure out how to do that well. She's like, I don't know what you guys think is so hard about beating 55. You know,
Right.
so.
I'm going to unmute Jeff in the audience. He's raised his hand, and we'll see if he has a question for us. Jeff, I cannot unmute you. You have to unmute yourself, Jeffrey Bond. And if you unmute yourself, we'll be able to talk to you.
Can you hear me?
We can hear you. Go ahead.
Well, I don't have any questions right now, but thank you for asking.
Well, you raised your hand, so I'm going to put your hand down now, Jeff. Okay, there I go. It's down, and we'll put you back on mute again. Thanks for being here tonight. We appreciate it. And let's go to our next slide here. And our next slide talks about the top 20 in the roundtable. We have quite a few holdings in the roundtable because this is a tracking portfolio, keeping track of every single choice that we've made in the last 14 plus years. But here's the top 20 holdings in that portfolio. You can see that Microsoft is our biggest holding right now, representing almost 13% of the portfolio. And you can see it's worth well over $100,000. That legend at the top of the page will tell you how many times we've chosen various stocks. We've chosen Microsoft 5 times, and I can tell that because it follows the 5X up there in the legend. Our most widely chosen stock has been Cognizant Technologies. It's been chosen 15 times over the last 14 years, and Google comes in a distant second at being chosen 12 times, along with Michigan favorite Gentex. So we look down this list. There's most of you should recognize many of the names on the list. The one that always draws my attention, that I always look at, is Costco, because Costco's not in the legend. And Costco's not in the legend because it's a one-time choice. And we don't put one-time choices up in the legend up there. But that one-time choice of Costco is worth over $20,000. And I make the same old sad joke every single time. Our only regret is that we haven't chosen it more often. Mark, anything else jump out at you from this page?
Yeah, and with Costco wholesale, it doesn't include the special dividends, which have been actually quite sizable. They're in the total performance, but they're not reflected in this position because they're just paid as special dividends. So also interesting. I do think some of the suffering here over the last couple of weeks, perhaps even month, I hadn't noticed how much Novo Nordisk and Regeneron had come down in price. And there have been a couple others that have taken a little bit of a breather. from stock price advances. So that we have lagged a little bit, but not bad, not bad.
Yeah,
I,
all in all, I think we're doing pretty well. And for a group of amateurs, I think we're doing extremely well. Okay,
and I don't know.
let's look at the next slide.
Do you want to talk about the managing that return, or do you want to wait for another month for that?
I think we should talk another month about that and do a little bit of research on it first.
Okay,
Yeah.
yeah, get us some
Yeah.
information, because I
I
think.
was
Yeah, go ahead,
while
Sal.
I was listening to Ken setting up the portfolio, I did a little math in my head that relates a little bit to what you were just saying. So it's something for us to all be aware of. These 20 stocks are 2/3 of the value of the portfolio. It's roughly 67%.
That's an interesting statistic, Si, because that kind of matches what the top 20 or 25 holdings in almost any mutual fund represent of a mutual fund, no matter how big the fund is as well. Usually you can get up somewhere between half and 2/3 when you look at the top 20 or 25 holdings in a fund too. So
Yeah, that
that's
surprises me
a
a little.
very interesting statistic. Yep.
Yeah, and we will be back on this subject of talking about you know this is not a typical portfolio. We say that all the time. It's a tracking portfolio, but it's still, we are keeping track of individual results, and we've always had this goal of maintaining a market beating projected annual return for the portfolio. And it seems like it gets a little bit harder every time we slow down on any selling or weeding of the portfolio. And that's kind of what I'm just leaving it out there for now as a question mark that we're going to come back to. When we slow down on the selling, do we get some pressure to the downside? Is one of the questions. So anyhow,
Well, they're good questions. We always take a look at stocks that have an RSI. That's a relative strength index, and that's a technical indicator that we just use for information. We don't. It's not an absolute by any way, shape, or form. But when the RSI in a stock gets above 70, the market says that might be a time when you'd like to sell the stock. It might be a signal of it being overvalued a little bit. I'm kind of intrigued by the fact that 3 of our September choices, that's just a month old, 3 of our September choices have really moved up into the stratosphere, Lamb Weston and LPL Financial, and they're giving us relative returns close to 18% right now. I don't think we want to get rid of 3 brand new holdings,
they're a month old.
but that SCI Investments is really old. It's over 12 years old, and I don't have any emotional tie to SCIC Investments. The market has been returning over that period of time since 2010, 14%, and we've returned in the stock about 12%, while the market's returned about 14%.
And that's
so
okay.
That gives us a negative relative return, but SCI has served us fairly well. If we want to get rid of it, I have no problems with that. And I think Wyndham is relatively new to the portfolio, only 4 years old, and it's matching the market pretty closely right now. So my instincts would be to keep Wyndham in the portfolio. Down below, we also like to look at stocks where the par has really moved down towards 0. And we have 4 stocks in that position tonight. I'm going to move Intel and Pool, both of them, out of the portfolio. I'm going to keep Boot only to keep Kevin Gologly happy in the audience right there so that we don't hear a lot from him. And we're kind of trying to follow the advice of Mr. Nicholson when he told us to be very, very slow to pull the trigger on something that's growing fairly quickly. We have both Costco and Boot Barn growing at 8.5%, 9%. And so I think we'll be slow to pull the trigger on both of them.
This is no different than when you basically play with the numbers on your stock selection guide to get them to come out to what you want the answer to be. So we're going to round those up to 10 so we can ignore them.
Okay, great.
Now I know nobody out there would ever do that with their stock studies, but
So, Marcus, do you have any problems with us unloading SEI, Intel, and Pool Core?
well, I vote against
Okay, well
SEI.
then, go on.
I haven't looked at it, but I have a feeling that SEI's probably got a fairly decent return forecast, and it just keeps chugging along. Plus, I think it's one of the oldest in the portfolio, so I will get a little bit nostalgic about the fact that it's been there since 2010.
Okay, I'll back off of SEI then. How about Intel and Pool? Any problems with moving it out of the portfolio, those two?
I've sold
I-
Intel from my personal portfolio, so yes.
Yeah, I have no problem with either of those.
Okay, well, let's move those two out. That's
Okay.
only moving 2/10 of the portfolio size-wise out, but it's a start. It's a start.
Hey, we're nibbling at the task ahead of us.
All right.
Good stuff.
Let's go to our next slide, if you would, Mark. We're celebrating the anniversary of Black Tuesday. That happened 95 years ago. Most of you, I don't know if we have anybody that was alive 95 years ago, and if we do, congratulations. But we have our Mr. Black Cat, Tuesday the 29th, marks the anniversary, and that's tonight. That was way back in 1929 when the stock market did its first crash to help begin the Great Depression,
Yep.
which lasted well into the 30s. And a lot of people say wasn't really solved until the country entered into World War II, when the Great Depression finally began to resolve itself. So it's an anniversary that I'm not especially happy to celebrate, but Mark threw the slide in here, so we'll say hi to the Black Kitty.
I don't know if I would celebrate, and I want to know if Cy and Barb have a cat that resembles that cat.
No, we do not. We
Mark,
have.
I do, Mark. So
You do.
This is Olivia. This is Olivia, all dressed up for Halloween. Yes. Okay.
All right. Go ahead, Cy.
I was just going to say we have an orange girl, so she's kind of pumpkin
Complimentary.
colored in the
Very
right.
complimentary.
Yes.
Yeah, I have a black Olivia, and I have an orange one too, Si, called Archie. And Archie is orange, and Olivia is black. So they're great at the door when the trick or treaters come. I'll tell you.
All right. Dear audience, it's my fault for getting these two going on their cats. It's not really a day to celebrate so much, but I will, just on a slight tangent, point out that this day literally inspired Arnold Bernard to start the Value Line Investment Survey. And the reason was he had watched his mother get massacred with her investment portfolio, and he basically wanted to build some type of tools that could help guide her as a long-term investor. And of course, their principles very closely match ours. So we can celebrate that the events of this day inspired Value Line. All right. So with that, speaking of great investments, let's go ahead and open up the floor for Cy and Genuine Parts Company.
All right. Thank you, Mark and Ken. Good evening, everybody. And I'll go ahead and confess right up front, we're talking some home cooking tonight with Genuine Parts. Atlanta-based company, and in fact, the headquarters are up not very far from another Atlanta landmark that certainly the whole world has heard of, called Truist Park, where the best baseball team, although they're a little on hiatus right now, the Atlanta Braves play.
They're golfing, Cy. They're golfing.
They're golfing. There you go. So here you can see the historical record for the last 10 years for Genuine Parts. And notice they're selling near the 52-week low. So that's a potential attraction. And you can see how that has fed into Value Line's 18-month projection of potential gain of 35% in the next year and a half, and longer term between 15 and 26. So let's unpack genuine parts a little bit. Here's a quick industry study for the specialty retail, which, as you can see, is a little bit biased toward automotive retail. I guess about half of the highest quality there are automotive related. You can note that by and large, it's a relatively fairly valued industry, at least again above among the high quality companies. You see there are two companies with the highest PARs, double digit PARs that are excellent quality. And just notice one of the quirks of Manifest every now and then. You may say, why is Genuine Auto Parts at 80 when and green in quality rather than blue? Apparently, Mark has lost his mind, I guess is the reason. The real reason that probably Mark can explain, but I have always pretty much understood that's a rounding issue. It rounds to 80, but in the actual underlying database, it's 79 point something. And so the code that says you got to be 80 codes it is green. So anyway,
79.99, but okay.
99, yeah. So there you go. So it's an excellent quality company, and I picked it over Ulta Beauty for a couple of reasons: slightly higher potential return. Plus, I had already this was checking it as a second opinion, and also I kind of like the 2% yield. So that's how we ended up with Genuine Parts. All right, the next slide. As I mentioned, headquartered in Atlanta, it's a leading global service provider of parts, hence the name, Genuine Parts. Automotive parts, think Napa automobile parts. That's one of their big groups and market segments. And the other is industrial parts group in the United States, known as Motion. And it's the second largest industrial distributor in the U.S. I did not realize they were as big in that space as they were. I knew of the Napa side, but I did not realize that the Motion was as big as it is. I don't know how it compares to now they just slipped right Granger.
Oh, right. To Granger, yeah.
How they compare to Granger, but that would be the largest, and Motion would be the second. And the company's kind of final description of itself: we keep the world moving with a network of over 10,700 locations across 17 countries, and they have 60,000 teammates or employees. Next slide. Here's just a visual depiction, a little bit of what we were just talking about. The majority of their revenue comes from North America, with another good chunk from Europe, and then south, east, and farther down Asia. I learned another phrase, Australasia. There we go. I knew that part of the world, but I hadn't quite heard that description. I may be behind everybody else on the call, but there you go.
First
and then you just, yeah. So there you have it. And of course, you've got the 17 flags at the bottom. Next slide. And here is essentially the company's description of its strategy. They accent talent and culture, effectiveness in sales, leverage technology. They, of course, a company that is a supplier should have a good supply chain, using the technology, both existing and emerging. And Genuine Parts also does engage in mergers and acquisitions. Usually not huge ones. They're more bolt-on, just accenting their business, but they do grow through M&A as well. Next slide. And here's how in this fiscal year thus far, 2024, they allocate their capital. You see the majority of it goes into mergers and acquisitions. It has thus far this year. The next biggest chunk is reinvesting in the business itself, the growing the business. Then they have a large chunk paid out in the dividend. I already mentioned the 2% dividend, and it's a little over that projected into the future, as we'll see. And then they do have been using and expect to continue to use a chunk of the capital to repurchase shares, which helps boost the return over time, assuming that price follows sales that follow or that drive earnings. And of course, share repurchases accentuates that a bit. Next slide. Here is a picture in one chart over what happened to the company, why the stock, or what happened to the stock, actually, more so than the company itself. The company is on pretty solid grounds, just hit some challenging economic forces, particularly in the automotive area, but also in the industrial space as well, of slower than expected growth among their customers and thus among their sales. And so they had a disappointing third quarter report, and the price dropped drastically in response to the report, as well as the lowered outlook. For the rest of 2024, the company's looking to grow up to 2% as opposed to 3%. Now, when you're that small a chunk of potential growth, that is a statistically significant amount, but it's not earth-shattering to trash the price. EPS, they are from a slight increase or flat, now projecting a slight decline in earnings per share from the diluted earnings. And of course, they're adjusting it for their modifications that are non-GAAP, that if you go to the third quarter, the website, and go to the third quarter report presentation, which is where this is from, in the appendix, they actually tell you how they move from the GAAP diluted EPS that you see to the adjusted. But what I highlighted down at the bottom, because at least in the near term, cash is what drives companies. Accounting is nice to try and match expenses and revenues, but company bleeds cash and lives on cash. Notice neither cash from operations nor free cash flow are impacted at all by the decline. It's again, I don't want to call it purely accounting issues, because it's more than accounting issues. We'll talk about that slightly, but the cash and the company's cash business is solid. Next slide. So we're basically faced with that eternal question of, are the problems temporary or terminal? And the company says it's temporary. It's a headwind that we're facing in 2024, maybe into 2025, but we believe that we will overcome it, and we have a plan to address. You could see Value Line's view. These shares present a compelling opportunity at recent price levels. That was written about 3 weeks ago. It was dated the 18th, but actually written slightly before that, when the stock was selling $20 higher than it was now. Now, the return projections you saw on the first slide, that's as of today's price or yesterday's price, because that was an online calculation. If you look at the paper Value Line, they would be a little lower because of that difference between the 135 and the 114. So if it were good at 135, again, unless you believe the problems are terminal, it's even better. And Value Line cites both the dividend yield and, again, in this uncertain market, it's the highest financial strength company among its peers. So again, gives some assurance that the company can withstand the issues. And again, I didn't highlight it, but the company's been around since 1928. So I think they have weathered some storms, wouldn't you say, to include the 75 years ago Black Tuesday?
Yeah.
Is my math right there? So I think that this can be a buying opportunity. Morningstar echoes that. They give the company a narrow moat. And again, fair value of 132 and 4 stars. Next slide. So now let's get back to our tools. With that background, you see again just a reprise of the first slide, and then you see the actual dollars that lead to those charts, along with the management evaluation, which you can see that all a very strong return on equity and trending up, solid for a retailer pre-tax profit on sales and going up, and certainly given the company's history, manageable debt as well. Next slide. And here are my projections, just maintaining the 5% sales growth that they've done historically. It's not burning down any barns with its growth, but it's a solid, slow growth company, growing a little bit faster than the economy, with at least current and likely likely a normal inflation, certainly not growing faster than the spike of inflation that we did experience in the first few years of this decade. Again, projecting expenses and taxes to remain about the same as they are now, which again, there has been, because of pricing pressures and the slight dip in sales, giving a little bit less revenue to spread expenses over. The margins are somewhat under pressure right now, but again, analysts believe that the company can respond to that. The last quarter expenses are a little under that 7%, but the trailing 12 is about at that. So again, I'm not forecasting any real margin expansion, though there's certainly the opportunity for that. And that leads to an 11.82 earnings per share, little below Value Line and Manifest, and right in line, slightly above the Better Investing median of everybody who uses online tools and their projection if they have done a GPC SSG. Next slide, which I think will wrap us up. Nope, one more. This just is where the PEs come from. Again, you notice very, with the exception of the pandemic year, very steady, consistent growth in the sales and the earnings historically that we saw, and reflected in the PE history. Not outrageous PEs, because it's not an outrageous grower, but very consistent. And I certainly feel very comfortable projecting a high PE of 23 and 13 for an average of 18. Next slide. Now we're wrapping it up. Here again, you see the forecast yield in that 2% range of where it is, a little using high PE, 1.5%, right at the 2 for the average PE yield, giving a projected annual total return of between 13 and a little less than 20, depending again on whether you use the forecast high PE or the average PE. Both are good, solid returns in this market. And like I mentioned, I think a pretty conservative SSG, in that I'm not really expecting any miracles in the profit margin category, but I think the company certainly can maintain and may very well surprise us with an extra couple of percent in the profit margin, which could potentially boost the price even more. So I'm adding Genuine Parts to our tracking portfolio.
All right. Thank you, Cy.
Si, I have a question from the audience for you. Does Genuine Parts operate retail stores?
Napa Auto Parts is their, that's not all company owned. Some of that's licensed, but that is the retail side.
Okay, I asked the question knowing the answer, and the person is questioning the debt levels, but that means if they're operating stores, they're probably obligated to leases on those stores, and those leases are included in these debt numbers here and have been included since 2017 with the new accounting rules.
Yes, exactly. A very, very good point. I had noticed that and maybe should have mentioned it, but I have not checked the footnotes, but I concur with your assessment, Ken. That boost that you see in 2017 was likely putting the leases on the balance sheet.
Thanks, I appreciate it. I'm going to be talking now about a bank, and this is a bank that I've not had real good things to say about at various times in history. So my mind has been a little bit altered in the last 8 or 10 months after doing some research. We're going to talk about Axos Bank. The ticker is AX, and let's go to the first slide, Mark. Axos Financial is the official name of the company, and they're divided into 3 basic divisions. The most well-known division is the consumer banking arm of the company, but they also operate a commercial bank where they bank only to businesses, small, medium, and large businesses, and they also have a securities arm. They actually act as a brokerage. They do the same things that Raymond James or Charles Schwab or any other broker might do. So they have these 3 arms all contributing to Axos Financial. What's unique about the bank is that they have no branches. This is entirely a digital bank. Everything is being done over the internet, and there are no branches for you to walk into. There, of course, are a lot of people you can contact. You can deal with not only human beings, but you can deal with chatbots and you can deal with artificial intelligence, depending on which services of the bank you're going to be using. Next slide, please. This was provided by the bank itself, this chart. And where the numbers are high, they're supposed to be high. And where the numbers are low, they're supposed to be low. So a good number, a perfect number for return on average assets would be in the 100th percentile. This bank is in the 93rd percentile. And what that means is that only 7% of the banks have a better return on average assets. We've continually talked about ROAA as a great measure of how good a bank is, and we know that the average return on average assets for a bank is about 0.85. So when you're double that at 1.73, you're obviously one of the better banks in the country. In fact, you're better than all but 7% of the banks in the peer group. And the peer group for this particular chart are all banks with assets more than $1 billion. The return on equity is equally at a high percentile, as is the net interest income. NIE. I had to do a lot of research on vocabulary, and I'll try to bring you up to speed on some of these acronyms and some of the vocabulary. This is non-interest expenses. And non-interest expenses would be things like salaries, insurance for their headquarters. You get the idea what a non-interest expense might be. And when you divide that by average assets, you get a ratio, and the lower that ratio is, the better the bank's doing. A ratio less than about 40% is considered pretty decent. This ratio is in the 27th percentile, which means that 26% of the banks are doing a better ratio than Axos, but they're still doing pretty well. The one I want to really pull out is the efficiency ratio. A perfect efficiency ratio would be just over 0. This efficiency ratio is in the 6th percentile. So all but 5% of the banks have an efficiency ratio that is worse than Axos. And if you read in the orange box, it says the efficiency ratio ranking means that the banks have lower expenses when compared to their revenues. So you compare all expenses to all revenue, and you get the efficiency ratio. And these ratios for Axos are in an extremely interesting place as far as placement within their peer group. Next slide. I know that many of you have talked to me personally about banks, and you have concerns because you've heard these concerns on the talking heads on television about banks and about commercial real estate. So I dug real hard into commercial real estate. The Value Line report even points out that Axos does have a presence with commercial real estate. And so I tried to understand how big a presence. First of all, I noticed some vocabulary that I didn't understand. I was not aware of what a non-accrual loan was. But a non-accrual loan is merely a loan where the person who borrowed the money has stopped paying on the loan. So it's a bad loan, in other words. And bad loans make up 26 million. That seems like a large number until you look at the total balance of commercial real estate, which is $5.2 billion. So it's a very small percent. It's about 0.5% of their loans are non-performing. And then I went down to this pie chart at the bottom and had to ask myself, what is LTV? Well, LTV happens to stand for the words loan to value. And when a loan to value is less than 50%, that means if the property was worth $100,000, then the loan that was made on this property is less than half of that total value, or in my example's case, it would be less than $50,000 out of the $100,000. The loan to value number for all of commercial real estate for this company is about 3/4 or more of the loans are loan to value at less than 50%. Only a small sliver, 1/20th, 5% of the loans have a loan to value greater than 65%. So they've been extremely conservative, both in their non-performing loans and in deciding how they're going to loan the money out. By the way, after loan to values, as loan to values increase, so do interest rates on the loans. So if you're going to borrow more than 50% on the value of the property, you're going to pay a higher interest rate for that privilege. Next slide, please. Here's just a backup for those of you that are going to slides and don't necessarily have the dialogue to go with it. And this is just giving you an Investopedia definition of loan to value and then an explanation of the ratio itself. Next slide. I'm going back to this same picture, and I'm telling you again that you can look at this picture as part of their investor presentation, and you can convince yourself that this bank, this very unusual no branch bank, has been extremely judicious when it comes to making commercial real estate loans. Next slide. I then dealt with commercial real estate specialty details, and I kind of looked at the different types of commercial real estate loans that were being offered. The first type of loan is a construction loan, and many of us have been involved with building a house or watching somebody else build a house, and a construction loan is a pretty understandable kind of a loan. You take out a construction loan and then you borrow against that loan, and you end up with a mortgage, or you end up with a loan after the edifice or the building or the 3-story or whatever you're building is completed. A bridge loan takes you from planning to the actual construction. It's a very short-term loan, and it's at a much higher interest rate than you might take for a construction loan, which is traditionally at a pretty low interest rate because they're being taken out by builders and construction firms rather than companies and individuals. A pre-development loan is a fairly low interest rate, and a pre-development loan you take out to do planning when you're starting a major project. You might have to take out certain types of paperwork with the county or the township or the state. You might have to hire an architect and do some planning. You might have to deal with departments of sewage or departments of water or things like that. And pre-development loans cover those kind of costs. And again, they're relatively short term. And a stabilized loan was one that I had just never heard of before. A stabilized loan goes to a loanee, goes to somebody that wants to borrow the money when they've completed the construction, when the whole thing's done, and when it's rented at more than 90% occupancy. So once they've completed the apartment building and rented out more than 90% of the apartments, they can move to this stabilized loan. And again, the interest rates will vary because with the apartment being filled or almost filled, the interest rates will go down because there's less of a problem with the person that's taking out the loan paying back the loan. Again, we had that loan to value number over on the side, and you can see that the average loan to value for these specialty kind of loans is at 40%. What that means, again, is that if the property is worth $100,000, the loan is going to be for no more than $40,000. It's a conservative way of making sure that you end up with your money, even if the project goes belly up. Notice also that over 3/4 of these commercial real estate specialty loans are structured so that access is the first payment priority. That means if they do go belly up, access gets paid first from the assets that the company might have before any other payments are made to any other people claiming, making a claim on the pile of cash that happens to be there. Let's go to the next slide. The lifeline of a bank is its deposits. If you want to think of a bank as nothing more than a big pile of money where the money comes in and out, and your goal is to make the pile of money get bigger, that's basically a really nice way to think of what a simple bank is. And this is not a simple bank, but it still depends on deposits. Notice that the consumer part of the pie, the piece of the pie, is only one way that deposits enter into the system. They have all different kinds of ways. Fiduciary services, for example, will come from certified investment planners, people that work in the brokerage arm of the business. There are specialty deposits where you'll hold money for construction loans that hasn't yet been drawn, or you'll hold money for planning that hasn't yet been spent. They have a securities arm where, of course, the brokers will hold cash for their clients at various times. There's small business banking. There's distribution partners. That's an interesting one. It's called white label banking. And that's where a bank takes another product, maybe a credit card, for example, brands it with its own brand, even though it's really a credit card being operated by maybe Visa or MasterCard, but it's branded with the own brand of the bank, and then the bank holds funds as part of their asset base for that white label banking. White label just referring to a kind of a bolt-on piece that the bank can use in fintech without having to create the piece itself. So this bank is really diversified in gathering deposits in a lot of different ways. Next slide. The deposit growth back in 2013, when the bank was just beginning, was mostly timed deposits. Think of deposits that expire. So think of certificates of deposit or treasury bonds or things like that. Notice that in the last 11 years, the bank has taken those time deposits and reduced them to only 5% of their total deposits, while raising the deposits from around 2 billion to around 19.5 billion. They have traditional savings as 2/3, and then the rest of the money, about 1/4 of their deposits, are coming from checking accounts and other demand kind of deposits. A lot of growth in total deposits and a huge shift in the kind of deposits. Next slide. Their customer base is all over the country. They will tell you that they have a presence in every single state in the union, including Alaska and Hawaii. So you'll see by the light blue circles or blobs on the map that they're particularly well represented in the Northeast and around the Great Lakes and over on the West Coast, especially in mid and Southern California, but they have a presence all over the country in every single state. This is a bank with no branches, but you can think of them as having hundreds of thousands of branches because they have depositors everywhere from Maine to California and from Washington to Florida. Next slide.
Ken, I'm kind of fascinated that the mid-Michigan area seems to be a little bit bluer. Do you have an account at this bank? Oh, just kidding.
No, I don't work. I bank at a credit union, Mark. Okay.
There you go.
Yeah. I got this slide from the website. This investor presentation that Axos puts together, they do a new one every 3 months, every quarter, and it's purely aimed at investors. And I will tell you, it's extremely thorough. There are about 85 or 90 slides in the investor presentation. If you're interested in Axos, I would urge you to get to know the bank a little bit better by looking at the investor presentation. This is some propaganda that tells you their universal key goals. And of course, it's a lot of corporate speak, but it also gives you an idea that they're very serious about serving their customers and having cross-sales opportunities. That's the reason for the 3 divisions. They hope that as you move into the bank as a young person with maybe just a regular savings account, that you will eventually move to the bank for all of your financial needs. And their goal is to be able to service all of your financial needs, from brokerage needs to any other kind of financial things you might need, including having somebody to help you with your finances, including registered financial advisors. Next slide. So we're looking at value line, and I've circled the earnings number. Value line is suggesting that earnings might grow at 12% out for the next 3 to 5 years. I'm looking at Yahoo Finance, and Yahoo Finance suggests that earnings might grow at 10% out into the future. I'm looking at Manifest Investing, and Manifest doesn't give me a percentage into the future for earnings, but they tell me that it might be something around $137 in 5 years. Those numbers are important, as is the Manifest call of the average PE for the next 5 years of about 11 or so. Keep those numbers in the back of your mind as we continue through 3 or 4 more slides. Next one. Back to value line again, and I notice about 57 million shares value line is suggesting might be available 3 to 5 years from now, and the income tax rate 3 to 5 years from now may be pretty much the same as it's been in the past, around 29.5%. Using those two values along with some research for profit margins, I come up with a preferred procedure calculation. If the sales are about 12%, then the preferred procedure suggests that the PAR might be about, that the EPS growth rate might be about 11%. Again, keep the numbers in the back of your head if you can. One more slide. Great visual analysis, and you might notice that I've added an extra line which is available in the SSG Plus for banks. It's that aqua colored line directly beneath the green line, and it represents assets. They're important because assets are what the bank it's that pile of money, and you want that pile of money to grow, and you want it to grow at about the same rate as sales. So that aqua line should be about parallel to that green line, and in fact, that's the way they look to me. I've used 12% sales growth. I could say 12% asset growth, and I've used 11% earnings growth. Next slide. I am showing you that the sales number of 16.5 and the asset growth number of 15.8 are near enough that I can use the two terms, the two growth rates, interchangeably. And I'm thinking of that 12% as asset growth rather than sales growth. I'm also looking down at the bottom line. That's a new line for banks in the tool. Most companies, you won't see that line, but for banks, you will. And you get return on average assets. We already know from the bank itself that they do extremely well when compared with a peer group. I told you before, 0.85 was for an average bank. 1.25 is considered very, very good. And when it gets above 1.5, especially for a 5-year average, you're looking at just really one of the best banks in the country. And that's what Axos appears to be. Next slide. I pulled up the quarterly growth numbers. Notice that I turned everything green at the top of the graph up there except for the trailing 4 quarters. So I pressed every single button up on top except for trailing 4 quarters. There I had to make a choice between quarterly or trailing. I wanted to show how many quarters the bank had met or exceeded my choice in sales growth and in earnings growth. And if you look, the green line is above the horizontal green line for at least the last 8 quarters. And the blue line is up above the horizontal blue line, which is just under the green line for at least the last 6 or 7 quarters. So I'm thinking that my expectations are not setting too high a bar for this particular company. Next slide. I'm looking at the historical earnings per share right now. I really like these companies that are clustered in the mid-teens and lower. I just get a real set of the vapors when I go up into 50 and 60 PEs, and here I am with a current PE of 8.4 and a 5-year average of 8.9. I'm happy with that. I'm choosing a high PE of about 12 and a low PE of about 6. And that gives me an average. 12 plus 6 is 18 divided by 2. That gives me an average of 9. Remember that Value Line had suggested an average of 12, and Manifest had suggested an average of 11. So I think that I'm being extremely conservative in suggesting 9. Now, what happens if they actually make a PE of 11 or 12? Well, that's all good news. I'll take it. But if they only do 9, which is right about where they are right now, I'd be happy with that. Next slide. The company does not pay a dividend. That's kind of unusual for a bank. And I would expect at some time that the bank will start to pay a dividend. But right now, they don't. Value Line suggests that the price appreciation might be anywhere from 6 to 17%. Manifest suggests an average par when you're selling at the average PE 5 years from now of about 15%. I'm looking over at the red circle on the right there. Since there is no dividend, this actually is pure price appreciation. And my gap, my number is somewhere between 12 and 19, certainly in the same ballpark that Value Line is. And my par value at 12.4 is on the conservative side of where Manifest is at 15.2. What happens if Manifest is correct? Well, that's good news. What happened if we hit 17% like Value Line says it might do? Well, that's good news as well. Next slide. That was it. I'm going to put $1,000 into Axos. And if you like banks and if you like the presentation, vote with me when we get to the poll at the end of it.
Well, the election is truly approaching rapidly. Good stuff. Thank you, Ken. I think that that's probably the most comprehensive look I've seen at Axos, and I will tip Bernie Meister's hat in your general direction. Bernie first talked about this company, which was known as Bank of the Internet, I want to say almost 20 years ago. Would that be true, Ken? Maybe not quite 20.
Close to, because it was before the crisis, before the financial crisis, because my stock club bought into Bank of the Internet when it first came out. And then as it crashed and burned around our ears, we thought better of our purchase. So we were not real happy. This bank was known in its early days for making loans on demand. In other words, you walked in without any kind of down payment and with very little paperwork, and you walked out with a home mortgage. That proved to be not the wisest strategy for giving mortgages, and Exos evidently learned a lot from its early days. And today it appears to be a very well-run bank, a very well thought out strategy. And I especially like the idea that it's in those 3 very large divisions where it can offer almost any financial service to its customers.
Very cool. Well, thank you. This is just our quick reminder, and it's not just a little nuance. This should hit you right between the eyes if you haven't figured this out yet. The small cap is not necessarily a small company, and it's something that we repeat every year. Ken made those graphs up at the top, or those graphics up at the top, playing around with his artificial intelligence image generator. And this is actually a quote from Microcap Club, who points out that some of the best performing companies were very small companies over the past 10 years. All right, and then just one slight tease. We are going to be doing our annual selection show on Saturday morning coming up at 10 a.m. Eastern time, and you can see the registration details down there at the bottom, and there are links on the the Mid-Michigan page and and Manifest Investing on the events listing. So we look to have it's always a good fun time, complete with yellow cards, red cards, and plenty of humble pie and all kinds of that kind of stuff. So you're all welcome to join us. Certainly invited to do so. Okay, here's
Mark, before you get into this slide, I'd like to welcome Hugh McManus to our back room.
Hey.
Hugh wandered in and has been trading hellos with everybody in the back room here. And he's back
Cool.
here with us right now. Hugh, why don't you turn your mic on and say hello to everybody?
Hey, everyone. I think I'm off mute now, I hope.
You are.
We can hear you.
You
We
know,
can hear you. Yep.
Perfect.
So are you on domestic soil or are you still globetrotting?
I am. Yeah, I just got in about a few minutes before the roundtable started, so I was able to join. So I hope I'll be more anchored for the next couple of months, so we'll be able to contribute as well.
Well, thank you. We would really enjoy that. I'm sure the audience has lots of pharmaceutical related questions that we would love to dig into with you.
Excellent.
All right. And Hugh, are you able to stick around after the session in case there's any banter? Yeah. Okay, fantastic.
Sure.
All right, so feel free to chime in. Good to hear from you.
We're already hearing from Joe. He wants an Ardelyx update, Mark. Okay.
Okay. Well, we all want that.
All right.
Well, I know you don't, Ken, because you already cashed out.
Yeah, I cashed out. Yeah.
with a 200% gain, by the way. Here's a quick look at what we refer to as the 100 Club at Manifest. This is a listing of the companies that have a Manifest rank of 100, which means they're in the top 1% of all companies based on their return forecast, the projected annual return, and their quality ranking. So it's literally basically taking these two, jamming them into a single characteristic and ranking them. And so you're looking at the ones who are at the top of the list. And there's a whole bunch of very familiar names on this list, I don't think, including the one that we just heard about. I'm sure Genuine Parts is not very far off the bottom of this list either. But just a bunch of really good companies. Some of these companies will be talked about on Saturday morning. And we have covered a few of these recently. I'm just going to dive in based on, I like most of these companies as study opportunities, but I'm going to go in. I'm looking for the one that might be a little bit oversold and perhaps a buying opportunity. And the first one that grabs me is Yeti. Yeti, ticker symbol Yeti. And we're basically looking at a company with a mid teens return, along with a projected return on value, which is basically very similar. Notice that value line has a very similar expectation also. You have Morningstar and the analyst consensus checking in and saying this thing is potentially on sale, and an average return expectation for the next year of above average 32% and about average sales for 25 over 24. So let's take a deeper look at this one. Here's a look at what's been going on with this company price-wise for the last 6 months. And it hasn't been going anywhere. It's basically been gyrating between 35 and 45 for the last 6 months or so. The relative strength index that you see referred to here, more on that in a second, is down into that oversold range. Anytime it gets down below 30, it's potentially interesting. One of the other things we like to do is take a look at a much longer, same type of concept, but this is a longer term chart. Notice that this one back here is daily prices for Yeti. This one here is monthly. And this one is going back a number of years. The first one's free on the site. If you go to stockcharts.com, you can do the first one for free. This one here does require a subscription, but it does allow you to look at monthly price activity going back for as far as it has been publicly traded, which in this case is back into the 2018 timeframe. So this just speaks volumes. Also, I mean, we're basically looking at a time when this MFI, which actually stands for Money Flow Index, For more on that, it's the same as RSI, only it's corrected for volume also. For more on that, you can actually go to this for free and learn a little bit more about this indicator. We love for this one to be down around 20. This was an interesting moment, down around 30. And it's the type of thing which we just use as a nudge. So we're actually pretty close to that 20 level. We're definitely at that 30 level for the other indicator. So potentially oversold, maybe worth a closer look. I don't think this company is a stranger to many of us. I mean, they basically make all that stuff on the upper right, that drinkware, those type of containers for people carrying around their water for the day. And I have to confess, Ken, I went in for a checkup just a couple of days ago and ended up, he wanted to actually strap one to me so I would drink more water all day long. So I now have my own Yeti. So I'm a personal customer. I mean, that dehydration diagnosis is not pleasant when your doctor threatens you with physical violence. So drinking water all day long is a good thing. These guys will help you do it and try to keep it at a desirable temperature. They have expanded out into all kinds of other equipment. They are recognized as a quality company, and you can see some coolers on the side. So again, no big surprise. So let's talk the milestones for the company, the type of stuff that we look into during our decision process as we study any company. You're looking at a perspective of the sales since 2017, and you can see that it's been pretty healthy. And the expectations are for this to be somewhere in the 10% neighborhood, perhaps a little bit higher than that. And you can see that the value line is checking in with a 10.5% for the next 3 to 5 years. Can certainly justify that 9 or 10% slope that you see in the image itself, in the visual analysis. And then you can see down below here, Mr. O'Sullivan is talking about low double-digit sales. So that actually qualifies it for our list on Saturday morning. It is in our current list of best small companies for 2024, and it's been one of the more disappointing companies based on what you see here. I mean, we basically bought it here, and it's down here now. So I believe we'll be picking this one and giving it another shot at the basket, unless Ken vetoes it.
I do know, Mark, that I'm collecting Christmas lists from the grandchildren, and Yeti used to be all over those lists, and it's not there anymore. So that's a little bit troubling to me. Yeah.
I need their cell phone numbers and email addresses because we need to support this company. All right, so what you're looking at here is, again, the price over the earnings for the company. You can see the earnings trend has been pretty good, but a little bit flat for a couple of years there. We'll talk a little bit more about that. But the stock price has been, languishing for a couple of years now. And one of the other things that I keep track of is Value Line's expectations a year ago were actually higher for 3 to 5 years out than they are now. I don't like it when it's going the wrong way. These are supposed to step up across the page, and when they go the wrong way, it's a little bit of heartburn. So as you look at the model for the company, we are looking at approximately $5 5 years out. And I think it's pretty easy to build a PE expectation based on looking at this and closing one eye and standing on one foot and jumping up and down. Somewhere in here makes a lot of sense to me. You could go as high as 18 or 19, but 15 or 16 makes a lot of sense. It seems reasonable and justifiable to me. So here's the situation. You have a company that is going to be at 1.8 billion something by the end of the year, growing at 9 or 10%. And again, generating that 5-year earnings per share of approximately $5. That's an earnings per share growth rate also of 9 or 10%. And with that PE ratio, these three milestones basically produce this 8% projected annual return. So it meets the return characteristics. It does meet double-digit growth. So it's probably worth our attention. The current price is at 35.68, pretty close to that turbulent low here lately, and some pretty decent expectations for the future. So let's talk a little bit about profitability. Profitability matters. When we look at earnings per share charts, we're basically looking at net margin graphs. That's what you're looking at here. I think it's also informative to take a look at the operating margin. And basically, the two are going to generally, for most companies and most industries, run in parallel. And what I would submit here, what you see the Wall Street rhinos reacting to, see, this is the price superimposed by the value line chart up here at the top. Notice that this uncomfortable languishing of the stock price uh, lines up pretty well with what's been going on with the operating profitability of the company. So if I'm actually buying shares of this company, or if I'm in an investment club where I'm the stock watcher, I got to be watching this number like a hawk. What I want to see from this company is a little bit more upside on this red line and basically flatten out this longer term trend with the operating margin. If and when they do that, you will get a reaction from the rhinos to the upside. And notice I said if and when, but if they are able to manage that and pull it off and return back to normal levels for profitability, perhaps with a little bit of upward trajectory, the stock price will probably respond pretty favorably. Here's a look at our chronicle over time. Again, we like to find companies that are consistently flatlining, at a high, excellent quality situation. That's certainly true with these guys. Very well managed company. The current projected annual return is actually up here closer to 18. It's not necessarily quite at that multi-year high that we like so much. This was the time we should have been having this conversation back here. And that is the peak. But again, hindsight being 2020, but it certainly would have borne itself out. We would have had to ride out quite a storm, but it would be doing pretty well right now. But again, we are fairly close to multi-year highs, so I do like this one quite a bit. Can they get back on the track or not will be the question to be answered. So I'm going to recommend we go ahead and initiate. I was kind of surprised we don't have a position in this company in the roundtable tracking portfolio. Like I say, it's been in the best small company portfolio for the last year. I think it might survive and actually end up in it again this year, unless Ken wrestles me to the ground and beats me senseless.
Well, I should disclose, Mark, that my family club owns Yeti in their portfolio, and the family club is doing the best of all the clubs that I belong to, and we're quite aware that there's a good forward-looking story on Yeti, and we've been putting small amounts of money into it on a regular basis. So we'll see if we match your assessment. I'm hoping you're correct when we do the whole thing here.
Well, since Hugh is here, one of the things that I used to love about Ken Janke, and I've heard Hugh McManus say the same thing, when we find a company like this that you can do like you've just suggested, Ken, accumulate, they actually like it when they get one of these patterns. And they just refer to them as recurring accumulation opportunities, says the Irishman. And it can make a lot of sense if you believe that the company is going to be okay and thrive and not be subject to size terminal problems. And I don't think these guys are anywhere near that.
The only thing that we talk about every single time we put money into it, Mark, is the fact that a lot of these products that they sell are subject to the same kind of whims that women's fashion is subject to. And it can be great today, and it can be something that you don't even look at tomorrow. I do know that the young people are looking at mugs with different brands on them right now, and those are the must-have water jugs at the particular time. Yep. So that's the only thing we talk about, and I think that's a serious question for them to consider as they move forward, because their products are not cheap. They're not cheap at all.
No, they're definitely very high value and a lofty price tag. And that's probably one other thing I should point out as a cautionary measure. A lot of times when we would make presentations to the Securities and Review Committee for Better Investing magazine, some of the pushback would sometimes center on the notion of it's a single product company. And then worse than that, it's a single product company that anybody with a garage can compete with. And so that is a risk that you have to admit. The last time I was in our local True Value hardware store, I noticed that their Yeti display was like 1/4 the size that it used to be. I came back a couple weeks later because I didn't get what my wife told me to the first time, and they had actually restored it to like 10 times what it was when I'd seen it a couple weeks before. So they are still there. They're very, very present, very available, but single product type thinking can it's definitely a risk to think about with a
Well,
company
Mark,
like
we're
this.
coming up on our time allotment here, so I'm going to launch the poll.
Go ahead.
And if you give me just a chance here, here we go. And I'm going to launch it and ask you folks to decide whether Access Genuine Parts or Yeti Holdings should be added along with our particular addition to the portfolio. If you don't like any one of those three, then select none of the above, and we'll be happy with that decision as well.
And Kevin Galogli, if you vote none of the above, we'll assume that's a vote for Western Alliance.
We do like to see 80, 85, 90% of you voting. We have a nice attendance this evening. So, oh, you've already pushed it up to 76%. Let's keep pushing there if we possibly can and see where we go. Meanwhile, while we're voting, I'm going to ask Bev Hornicle to unmute herself. And Bev, if you unmute, you can ask your question. And Bev is not responding, so I'm going to assume that's an inadvertent hand, and I'm going to take it down then, okay? So I'm looking at the poll right now, and I'm seeing that we have 87% people voting, so I'm going to close the poll, and I'm going to display the results. And it's been a few months since I've won one, Mark, but I won one tonight. Okay.
Restored the public faith in Axos as an institution. Cool.
Yeah. So it's time, Axos, for you to go all to hell. All right.
No, you can't say that after the last month with LPLA.
Well, you're right. I wish you would have all voted for LPLA last month. It really has gone wild here in the last 30 days. So we're going to add not only my $1,000 to Axos, but we're going to add $1,000 for the audience to Axos. And we're going to tell you that we are putting all of our presentations on YouTube. Our channel is called the Manifest Investing Roundtable YouTube channel. So do Google any of those words and you can get to us. If you go there and you haven't subscribed, please subscribe to our channel. We'd love to get the number of subscribers to a point where we can start using some of the tools that YouTube has available. We're getting a fair number of hits on a lot of our things. We normally get pretty quickly about 100 hits, so that means we have 100 people that wait for it to be posted and come to it almost immediately. I know that doesn't seem a lot when you consider these people with millions of followers, but Mark and I anticipated somewhere around 4 or 5 hits on any one of these when we started this whole thing. So 100 seems like a huge number for us. We are going to be giving you a couple of dates coming up. Don't forget that this coming Saturday at 10 o'clock Eastern Time in the morning, we will be talking about the best small companies for 2025. That will be the first time that we release the list. So come listen to the list as we release it. We'll be talking about the results from last year and the new list. Our November roundtable is the normal last Tuesday. And don't forget that every single Tuesday at 2 p.m., there's a bull session. And if you need more information about the bull session, take a look at the Manifest Investing website. You can register for that bull session just once, and then you'll be registered for any and all bull sessions you might want to attend. I do have a hand in the air from Cheryl. So Cheryl, go ahead and unmute yourself and ask your question. Cheryl Patterson, go ahead and ask your question. Gotta unmute first though. And it looks like that might be another inadvertent hand. So we'll take that hand down. And Mark, do you have anything to add to us right now?
Well, you know what makes me sad, Ken?
What makes you sad, Mark?
I only got 6%, so I might have to rethink and find a different small company for Saturday morning now for one of my picks. So.
Okay.
All right. I'll behave now.
All righty.
All right.
So we have had a number of folks ask some questions about Ardelyx. Hugh, do you have anything to tell us about Ardelyx?
I don't have any updates. I hope you can hear me. Don't have any updates. I haven't actually personally looked at Ardelyx in a few months, so I will get back to it.
Okay.
I'm hoping to be on the roundtable, the whole session next Tuesday, but I don't have any updates. I did reach out to somebody at Ardelyx to find out if they were interested in doing a presentation. They're currently thinking about that, so I will let you know if the answer is yes. And I can certainly understand the hesitancy.
Yeah.
I'm going to take two more questions, Mark, during the session here. Another one is for Hugh. Hugh, do you have any feelings or comments about Pfizer? Doug Broderick would like to know.
No, not on Pfizer or BMS or any of the large, the big pharmas. I just find it very interesting, actually, that when I was started in the industry, the mantra was rapidly becoming that the pharmaceutical companies, the majors, Pfizer, BMS, etc., were discovery and marketing companies, and that was it. They got rid of manufacturing and all of the intermediate steps in between, and that an outsourcing industry developed around that. Today, and Pfizer would be a good example of that, they have to a large extent also jettisoned discovery. And discovery is now being done by emerging pharmaceutical companies around Cambridge, Massachusetts, Bay Area, San Diego, hubs like that, Seattle as well, North Carolina. They've outsourced their pipeline as well, and just buy things in when they look promising. In fact, I was looking at an interesting statistic recently that Bristol Myers Squibb hasn't developed an in-house product in over 30 years.
Wow.
Everything has either been acquired or licensed. It's a fine way to run a company. I mean, they're quite successful doing it. Yeah, but these guys, I haven't bought Pfizer in a long time, but I certainly like to buy them when the price dips.
Hugh, just kind of a context question, a follow-up. With the large pharma companies taking that approach, they have considerable resources in terms of staff and facilities and sourcing and everything else, for the type of stuff that needs to be done to develop a drug. Is the outsourcing of this inhibiting innovation, or is it a good thing?
It's accelerating and it is lowering cost quite dramatically, particularly the outsourcing that's done to China.
Okay.
I know the Biosecure Act has put a bit of a wrinkle in all of that, but really companies like WuXi, a couple of companies in China are kind of responsible for accelerating the number of small molecules that have been approved recently in the last 5 to 10 years.
Okay.
And by the way, keep an eye on AI as well, because it is having a stunning impact on drug discovery.
It's good to hear.
Unreal how effective it is.
Thanks so much, Hugh. Mark, I'm going to ask you to press the button and close the session after we say goodnight to everybody, but we will stick around because we have some interesting questions to answer in the back room here. So once you close the session, Mark, I'm going to ask and get a couple of other questions answered, okay?
All right. Thanks, everybody. Take care.